Well, welcome, Sunny, to our chat today. It's really good that you could make it, and thank you for sparing the time. Sands Capital runs a concentrated portfolio for Alliance Trust of around 20 global growth leaders. Can you tell us something about the kind of businesses that are on your watch list and the sectors where you're most likely to find them?
Sure. Fundamentally, growth investing is about investing in the ways in which the world is changing. And at Sands Capital, we're trying to take a private buyer's mentality to owning public equities, really a business owner's approach. So we believe that if you're going to own businesses, you want to own them in attractive business spaces and only own the best and ignore all the rest. And so when you apply that framework to the global investment landscape, we tend to own businesses that have strong economics, like in the software space where there's large amounts of innovation, big changes in the way the products are delivered, a move from on-premise software to cloud-based software that's been playing out, we think, is a multi-decade trend. Similarly, you're seeing a proliferation of semiconductor chips used in many different types of products across a range of industries. So we have a number of investments in that space. Another example would be the innovation that we see in the life sciences space. And then of similar importance, you see an increased focus on the environmental impact of different types of products and services. So investing in businesses that are on the right side of change in terms of environmental impact. And that could be in the construction industry, the automobile industry, the electronics industry, manifests itself in different ways in the portfolio, but we have exposure in each of those types of business areas.
So, more specifically, could you talk us briefly through the 6 investment criteria that you follow when you're selecting companies?
Sure, let me take our 6 investment criteria and break it down into 2 groups of 3. The first 3 criteria are about the underlying quality of the business and the business space. So we want to own businesses that are leaders at what they do, have strong underlying business economics, and have built a significant competitive moat around the franchise. We believe that if you have those 3 characteristics, that will help enable sustained earnings growth at an above average rate. And we think that earnings growth is the ultimate source of wealth creation for equity investors. Our next 3 criteria wrap around those first 3 quality criteria. We want to own businesses with a clear mission and a value-added focus. That's where we embed our ESG-focused research work. We want to own businesses with financial strength. That allows a company to endure through a challenging time and invest in its own future without reliance on outside capital. And lastly, we want to pay a fair price for high-quality assets. So valuation is our 6th and final criteria.
Just homing in on the last criterion, that of valuation. How important is an attractive valuation when you're weighing up a company? Are you always waiting for a good price before you buy?
Valuation is important to us. It doesn't do anyone any good to own the best business in the world and make no money in the stock. But we look at valuation through the lens of both our investment approach and our time horizon. And our approach is to own businesses that we think are very high quality, typically quality trades at a premium, businesses that are growing their earnings and cash flow at above average rates. That also tends to drive a premium valuation. And empirically, one thing that we understand is that the longer your time horizon, the lower is the impact on your final realized return from paying a higher or lower price. It's ultimately the compounding of earnings growth that swaps the ebbs and flows in valuation. In fact, if you decompose returns over long periods of time, you see that earnings growth is the predominant driver of return, and valuation is mostly a driver of volatility. So we ultimately want to pay fair prices for very high quality assets, but we are not going to wait to try to pay cheap prices for mediocre or good assets. We understand that we often have to pay up, but we want to make sure we're paying a fair price in the context of what we do.
So how has the portfolio performed, both relatively to its benchmark and absolutely over the past, let's say, 3 years?
So over the past 3 years, the portfolio has underperformed the All Country World Index, and it has performed roughly in line with the growth style of that index. So it's down roughly with growth, but it's been a very challenging period for growth, particularly here in 2022, and it's been a similarly challenging year for the portfolio. So the portfolio as a whole is unfortunately down about 45% year to date versus the All Country World Index that is down roughly half that amount. That's obviously an extremely challenging 1-year performance. Our view, however, is that the underlying earnings growth of the companies in the portfolio continues to be extremely strong and will ultimately overwhelm that multiple compression that we've seen over the near term.
So you've mentioned that the portfolio is down quite heavily this year, and this is presumably partly because of the rotation out of growth-focused companies and towards more value-focused companies. Is that something that worries you seriously, or are you taking it in your stride?
We're taking it in our stride. Certainly, the short term is quite painful for us and all of our clients, but ultimately, we don't think that anything fundamental has changed for the growth outlook and the types of businesses in which we invest. Over our 30-year history, we've seen multiple periods like this where our investment style is out of favor, and we always like to come back to basic principles and focus on the difference between a stock and a business. There has been a style rotation out of the types of stocks in which we invest. But if we get back to fundamentals, the underlying changes in the world that are creating the investment opportunities for the businesses in which we invest have not changed, and in many cases are accelerating. So our long-term outlook is unchanged, and we're staying the course with the types of businesses that we own.
So did you take any remedial action in relation to the holdings that you currently have?
Let me answer that question 2 ways. In terms of substantive action in the portfolio and changing the portfolio's positioning and the types of businesses we invest in, no, not at all. We think we invest in the right places, in very high quality businesses, and will be well rewarded over time. That being said, this has been a very significant market pullback. And one thing that I will take accountability for is we were a little bit over our skis at the end of 2021 in terms of our exposure to higher growth, higher valuation assets. And that hurt the portfolio coming in to this year. But secondly, from a business perspective, our investment team has re-underwritten the investment case for every single one of our holdings to go back to core principles, the foundational pillars of each underlying investment case, and ask ourselves, as we come out of the pandemic, as we go into a different interest rate environment, a different economic growth environment, has anything fundamentally changed with this business that should change our ownership? The outcome of that process was very little, but it was a very active decision to be relatively inactive in terms of the portfolio positioning.
And did you find that indeed the market falls have actually opened up some investment opportunities for you? Have you been able to buy the kinds of stocks that you are always on the lookout for at much more attractive prices?
In isolated cases, we have. Our house view is that equity valuations, with hindsight obviously, were quite extended at the end of 2021. So we've had more of a reconnection to normalcy, if you will, rather than an overshooting to very cheap stock prices. But in isolated cases, yes, we have initiated positions in businesses that we've been watching for some time that are now trading at what we think are much more fair valuations with unchanged growth outlooks.
rampant inflation and the very real prospect of recession are big problems for a lot of the developed world at the moment. Certainly they are in the UK. And I'm just wondering how those issues affect the kind of companies that you are holding in portfolio. Are they adversely impacted by inflation?
Well, no business in the world is completely immune to the backdrop of its operating environment. But our view is that the most powerful hedge against inflation is competitive advantage and having strong underlying economics in your business and being the best at what you do, because that's what puts you in a privileged position between your customers, your suppliers, and your competitors. So while inflationary impulses across the global economy are a headwind for all businesses, it also increases the relative gap between the best and all the rest. And if I reference back to our 6 investment criteria, we typically frame those criteria as the means through which we seek to generate return for our clients. But it's also important to remember that in times of stress, criteria focused on owning quality are also a very important risk mitigation tool.
You mentioned earlier on in our conversation that ESG is an element of the whole selection process. Can you tell us a bit more about that and how important ESG considerations are when you're selecting stocks?
It's quite important, and it's integrated to the front end of our investment research process in the same way that our financial and qualitative criteria are part of our research process. So it's an inherent part of our investment criteria, and we tend to be quite actively engaged across all of the businesses that we own in the portfolio. And a particular strength of ours is that because we are long-term investors, we tend to be the types of investors that companies and the management of the businesses in which we invest are open to listening to, engaging in more in-depth and constructive dialogue, because we're the types of investors that a lot of companies want in their shareholder bases. And so we think that helps us with the effectiveness of our engagement and aligns us with the businesses in which we invest in a way that is very difficult to do if you have a shorter term holding period. And then another comment that I would make is that when you invest in quality and leadership, being forward thinking about your impact on the environment, your impact on the world around you, and your governance structures tends to be an embedded part of being a leader. So by looking for leaders, we tend to find businesses that are on the right side of change, that are already operating at a relatively high level with respect to ESG, but importantly are also open to engagement for the continuous process of improvement.
Could you give us an example of the kind of engagement that you have, that you've embarked on?
Sure. There is, just recently, we've been engaging a software business in the portfolio around potential misuse of its platform. It's a globally distributed cloud computing platform, which can be used by unsavory entities and to promote unsavory content. And we have done our own independent analysis with independent IT experts to understand both some of the principles as well as the technical the technical dynamics underlying how the platform can be misused, and how the company might do a better job of detecting that. And we have turned around and begun engaging management more directly, saying as you become a larger, more mature, more seasoned business, you're going to need to make the investments in these types of moderation tools to take those next big leaps in your growth. It's also the right thing to do. And by doing our own independent research and then going back to the company rather than just following the company's lead, we think has allowed us to have a more productive and more impactful engagement. That's ongoing, which is why I'm not mentioning the name of the business, but that's the type of work that we like to do.
great example. Thank you. So at a more granular level, looking at individual stocks, are there any particular sectors where you've really found interesting opportunities recently?
So, as I mentioned earlier, growth investing is really about investing in the ways in which the world is changing. And within that, one highlight that I would draw out are businesses that are benefiting from or helping to drive increases in the efficiency of commerce. And two broad categories would be payments and then e-commerce. And we own businesses like Visa, which is the largest electronic payments business and is benefiting from the migration in the way people pay, moving away from paper forms of payment to electronic payments. We own companies like Square and Adyen that help in the processing of electronic payments. And then in the e-commerce space, we own businesses that operate in different geographies around the world with different business models, but broadly speaking, are benefiting from the trend of offline commerce moving from offline to online. So businesses like Mercado Libre, the leading third-party e-commerce platform in Latin America, or Shopify. We think of Shopify as almost the operating system for e-commerce that does not take place on the Amazon platform. And we own Amazon, a business that is still growing at quite above average rates despite its scale. Electronic payments are growing nearly double digits, and e-commerce is growing in the mid-teens on a secular basis around the world. So businesses that are benefiting from the changes in the ways in which we pay for things and the changes in ways in which we buy things.
And what about businesses, stocks that haven't worked out so well? There must be one or two disappointments along the way.
Oh, absolutely. It's unfortunately an occupational hazard in managing a portfolio, and that's why we manage a portfolio and don't own just a single stock, even though this is a concentrated portfolio. Twilio would probably be the best example of a recent business that did not work out the way we had anticipated. And in short, Twilio offers a service that is effectively the communications layer in any app-based product or service. So when you use the Uber app and you communicate with the driver, that correspondence is enabled by the Twilio platform. And essentially what they do is they simplify the complex world of global communications down to a single line of code that an app developer can put into their app. And whether it's a transportation app, whether it's your bank sending you a text message for dual authentication to log into your account, a lot of different use cases for their products. And we thought that this was a business that had tremendous potential. And really where we lost our conviction was through a series of management missteps. The internal operations of the business were not as mature and developed as we believed. And we saw a number of operational missteps. We saw senior management departures. And all of that came together to impair, in our view, the company's ability to execute on its market opportunity. And so after about a 2-year investment period, we exited earlier this year.
Right. Well, to finish off, could you possibly tell me about, for want of a better word, a wild card stock that you own, something that's a little bit left field or esoteric? And I appreciate that quite a lot of what you're looking at is kind of almost by definition fairly out there in the 21st century. But any stocks that you think are really quite unusual and also quite exciting?
Well, how about I give you a recent example that I think is maybe the most fun stock in the portfolio to do research on. It's both an old world company, but also a very modern company, and that is Formula One, the auto racing circuit. And Formula One ultimately is a media asset, just like any other sports league. You do something that's entertaining and you sell advertising against it. And a few years ago, a US-based company called Liberty Media purchased Formula One with the idea of improving monetization. So if we were to look at other sports leagues, the British Premier League, for example, generates about $3.50, $3 per viewer hour. Formula One generates about 30 cents per viewer hour, and only about 15 cents per viewer hour in America. And I always joke, I know what folks on your side of the pond think of American football. American football generates about $1.50 per viewer hour. So what those examples show is there is a tremendous runway to grow the monetization of the Formula One franchise over time. And we think that as that happens, you'll have very high incremental margins and shareholders will be well rewarded. But it's a very different type of business than the quote unquote typical business you would find in one of our portfolios.
Yeah, certainly sounds like it. Well, thank you so much, Sunny, for taking the time to talk to us. It's been a real pleasure.
My pleasure as well. Thank you.